Hello everyone, Mehdi Photocall for mine. So today we're going to see that if you're invested only in the US stock market, your portfolio is definitely not ready for the new world order. What do we mean by that? Well, so first of all, the thing is that, as we can see, there is kind of a de-dollarization of the world happening, with the dollar actually losing a little bit of its value. So we're gonna see today why staying only in the US market is not aligned with the changes we can see in the world, and especially with the dominance of different countries. So of course there are outliers like China, but the thing is that the world order is going to change and the US is not going to be as dominant as it has been in the past few years. And so in your portfolio, you need to take that into account. And so if you do not, you will definitely lose on terms of performance. So the first thing is the rise of China. So China's GDP has actually been below America's GDP for quite a long time, even though that China has been growing much faster than the US. But there is one thing that you have to take into account in your investing journey is the way things are measured. And so China's GDP has actually been underreported for quite a long time. There are a lot of people actually talking about that and reporting that, but the way GDP is actually reported in China and in the US is totally different. And so the main point of the argument is that in China, like, consumption is actually underreported. And so the fact that China's GDP has been driven especially by manufacturing has led the reporting of the GDP mainly actually supported by this type of industry and this type of growth. But the reality is that China or Chinese industry is actually consuming much more than what they are reporting. And we can see that especially when we look at numbers like the number of cars produced and bought in China. This is very comparable to what we can see in the US, and that's true for a lot of other goods that we can see also in the markets. And so the point is that China's economy is actually much bigger than what you might think. And the reality is that China's stock market today is actually at a very low historically. And what we can foresee is that in the coming years, if China finds back growth, especially in terms of economy, but also in the stock markets, this is most likely that China's stock market is going to outperform significantly the US market given the current valuation of both stock markets. And so if you want to actually benefit from the growth of this Chinese economy, so you have to be invested in China in some perspective. And so I think it's a big mistake for any investor to really ignore China. There are a lot of different plays with China, but the thing is that you cannot ignore the second or even the first economy in the world. And so as an investor, especially as a global investor, so if you don't live in the US and if your currency is not the US dollar, that doesn't make much sense to actually rely only on US stocks. And so I really advise people, even though it's not financial advice, to really look really deep into investing in China or China-related stocks, or I would say a basket of stocks if you're not comfortable with individual ones. And so to finish this first point, the thing is that Chinese economy is going to grow and we are going to see a pickup in terms of consumptions. And so the companies are going to benefit tremendously for this rise in terms of consumption and this change of economies, so going from manufacturing to consumption, are companies like Alibaba, JD.com, Xiaomi, BYD, for example. And so definitely these are the type of companies you want to be in if you think and if you believe in the long-term growth of a country like China. And then beyond China, there are a lot of great companies that you can even purchase today and that have a significant growth pathway in their own respective regions. So if we look at, for example, in the Southeast Asia region, so we have companies like Sea Limited with Grab, for example, which have a huge growth in front of them, especially because like they have the same business model as in the US, but applied to their local regions. And we can see also that the population and the economies of these countries are still continuing growing at a very fast pace. And so these companies are going to benefit tremendously from the growth in the Southeast Asia region. And we can see also the same thing in Latin America with companies like Mercado Libre, for example, or like Nubank, which also have like very large growth. And so just to say that what we are going to actually experience is that a lot of great companies are going to emerge in different areas of the world. So we are going to live in a multipolar world where great companies are not going to be only in the US, but also in all the different regions. So that's why your portfolio should not be 100% concentrated in the US if you want to take opportunities with these great companies. Well, so next we're going to see like how the US market is so overvalued that it is actually a big risk in your portfolio. So indeed, like what we have seen, so basically post-COVID with a lot of liquidity into the US market, is that the valuation of the US market has actually grown very high, even though that in 2022, with the rise of interest rate, we have seen a huge drop in terms of valuation, but it has come back at levels that never seen before. So when we look at all the different indicators that can assess how expensive the US market is, we can see that we are at historical levels. So in terms of Buffett indicators like market cap over GDP, like the Shiller P ratio, for example, what we can see is that in terms of valuation, the US market is one of the most expensive it has ever been. There are some factors that can actually explain why it is the case, because we can see that the most dominant companies, so especially in the S&P 500, are tech companies, which usually deserves much higher P ratio. But that's one thing. If we go beyond the fact that the most prominent components of the indexes have actually higher P ratios, even historically, these companies or these peer groups have ratios or multiples which are much higher than their historical multiples. And so what we can actually foresee is that the US market may actually suffer from a rotation out of the US market into less overvalued regions, like, for example, China, or I would say more broadly, Asia. And this may accelerate even more if we can see two things. First, a decline in terms of growth in the US, where this may or may not happen, but the fact that the US may not be the most dominant country in the world going forward may actually rebalance the cards, especially towards Asia. And so the second thing is basically the fact that a lot of countries are going to lose trust, especially with the Trump administration, with the United States, and we are going to see a lot of investors around the world pulling out their assets from the United States, what they have actually started doing, and actually repatriate them or just reinvest them into other countries or other areas in the world. So the fact that a lot of investors so far, a lot of global investors have concentrated especially into the big tech in the US, which is going to be actually pretty tough for the US market at this type of valuation. So all of that is actually very true if you are a US investor or if you are a global investor. But if you are a global investor, I mean not residing in the United States and you're not using the US dollar as your primary currency, you definitely have to diversify, because you cannot have your whole portfolio denominated in US dollars if you are not living in the US and if you don't have your living expenses in US dollar. Because what we have been seeing actually quite recently is a lose of faith for the US dollars, and most likely going forward we will see some kind of weakness in terms of US dollars as a currency and a kind of dollarization of the world. And so this means that you as an investor, you cannot really predict the future. So the smart move here is actually to try to diversify in terms of currency. And when we say currency, we mean in which currency your company in your portfolio are earnings, basically. So if we take the example of Alibaba, so Alibaba is listed on the US and the Hong Kong markets. So there is a share price in US dollar and in Hong Kong dollar. But actually it doesn't really matter, because Alibaba is earning essentially all of his profit in renminbi. So which means that you are exposed directly to the Chinese yuan if you are investing in Alibaba. And so that's the same type of things for companies like Mercado Libre, for example, with an exposure especially to Argentina or Mexico, for example. And so if you want to diversify your exposure in terms of currency, this is actually very important for you to go outside of the US. And this is where you can find some opportunities to find great businesses, but also that are going to benefit from a rebalancing in terms of currency in the market. So we've seen today why you absolutely need to diversify away from only the US market, because your portfolio is really at risk of not being prepared for the new world order, which is multipolar and not under the dollar reserve currency. And so that's why you have to identify in these other regions in the world, so these stocks that are going to outperform the market. So we have given a few examples of already winners, so in the field, so either in Southeast Asia with like Sea Limited, with Grab, so in China with like Alibaba, JD.com or Tencent, or even in Latin America with like Mercado Libre or like Nubank. So the focus for you, I think, in the conclusion of this video is basically you need to have an open mind and try to go beyond what has worked yesterday but might not work tomorrow. So you need to be prepared, you need to prepare your portfolio for the change in the world. And so that's why, so today that was an explanation on why you need to diversify away from US stocks. And so if you're interested in this type of content with analysis of the Japan, Asia, and US markets, feel free to subscribe to the channel and check my other videos, and I see you in another one. Bye.